I did it, ladies and gentlemen. I hacked everything money. That's right. I went to coding boot camp over the weekend. I studied my hacking skills. And then I went on their servers and I dived into their software. And I learned all those top secret formulas that they use to calculate the buy points for their stocks on their stock analyzer tool. I'm just kidding. Welcome back to Strongman Personal Finance. If you don't know who I am, my name is Christopher Bell. I'm a certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser, and a big fan of everything money software. And I told myself, well, let's say they go out of business or they start charging $1,000 trillion per hour. What if I had to do this on my own? How would I analyze stocks without their software? I think it's pretty freaking good. I'm promoting their software. I think you should sign up, okay? Maybe they should give me a discount on my software because I'm promoting it. Anyway, I decided to make my own software. Well, it's not really software, but it's in Excel. And I've already shown it to people before. But what happened was Morningstar screwed me and didn't allow me to download Excel sheets. So now I had to go and recreate it. And I'll show you the website I use to copy and paste the information. And I'll show you exactly how I made the financial data, how I structured it, and you can always improve upon it to make your own tool, okay? But it's discounted cash flow. I mean, anybody can make it. There's no monopoly on discounted cash flow. What I'm not going to do is I'm not going to sell you this, and I'm not going to upload it because I don't want to get freaking sued. But I want to kind of give you an idea of exactly how they're calculating the numbers that you see. And then you can make your own judgment if you agree or not with how they calculate their buy points for their stocks. So first, let me show you where I actually got this information from. So I went to ROIC, I guess return on invested capital.ai. If you go there, this is a free website for now. I mean, maybe they'll start charging in the future. But you could type in any company. Let's try DocuSign. Well, actually, they're crap didn't pull up. Let's try Apple. Type in Apple in the search bar. Very easy. You can actually go and look at their full financial statements, and you can copy it to your clipboard, and you can actually pull it up into an Excel file, and it should copy over. Now, if it doesn't do that, yeah, it actually did. It's nice. Look at all this freaking information. This is financial information for Apple going back to 1985, okay? It's pretty ugly when it copies over, but, you can do your own formatting. Another alternative is, I gave you a preview of my tool, you can export it to Excel. Now, they require you to tweet about their website. That's it, which I had to do, which is fine. I tweeted about their website, and that allows you to export the Excel. So I think what it does, it just gives you a cleaner export than this crap that they give you. Saves you a lot of time. Yeah, look at this. So compare this, which is exporting the Excel, to this, which is the financial data, but it's ugly and it hurts my head, and I don't want to fix this. So this is a lot cleaner, but if you don't want to tweet about it, you don't have to, okay? So anyway, what I did is I took this information, which sadly, it's not always 100% up to date. You have the 2021 information. You always want to verify that it has the most recent, trailing 12 months of revenue in financial data, because that's what you're going to use. But it's a pretty good approximation. I literally just copied it, copy. And then I went into my own analyzer tool, which not only does the same thing theirs does, but it has pictures of me, Kevin, Jeremy Lefebvre, Stock Blow, George Perez Lopez, whatever his name is, and of course the Dogecoin Douchenaire. It has all their pictures on it as well, so you get to laugh while you analyze stocks. But I literally just go over here to, well, I wasn't doing Geo, I was doing a different company, and you copy and paste it into there, and boom, you have all your financial information. Okay. Now, as you can see, the format of this is strikingly similar to their software. Why? Because I like it. Why? Because it's easy. It's convenient. It's very simple. It's easy to understand. Now, ignore this crap up here. I'm still refining it. But all the numbers that you type in here, revenue growth, share change, which they got rid of, I put it back in there. Profit margin, free cash flow as a percentage of revenue, PE, price to free cash flow, and desired annual return. all this information will change your buy points, and it will be exactly the same as their numbers. And I'm going to show you in a second. Now, another thing I added was a currency conversion feature. You want to be able to convert from currencies because sometimes when you copy over financial data, it's going to be in foreign currencies. So you literally need to go and find the conversion rate and copy and paste that into this block to actually get the converted currency amount. In this case, the stock that I used, it doesn't matter. Now, let's go compare the numbers I have here. Let me zoom out a little bit to the numbers I was able to pull up in their software. So I pulled up DocuSign, which is a stock that just got freaking annihilated recently. And I decided to use their financial information. Now, Everything Money stuff feeds in from Morningstar. But since I can't use Morningstar anymore, it's a freaking pain. Now I have to use this free website, which isn't as updated as Morningstar. Let's see if they actually have the most updated revenue. DocuSign. Down at the docks, because you bought DocuSign. Yeah, see, the revenue here is $1.4 billion for 2021. On Everything Money's, it's 1.96. That factored in their most recent earnings. So their stuff in Everything Money is more updated. So it's still a better choice. But you can actually go look up the information yourself. Like I actually had to go look up and verify the last 12 months of revenue for DocuSign and the number of shares outstanding. But using the software, I mean, it's pretty well updated. They give you the basic shares outstanding, all that good stuff. Now, let's compare the numbers. So let me pull this up. I'm going to screenshot this so it's easy to see. And then we're going to compare the delicious, superstitious numbers. And then we can change them and see if that changes anything, okay? So here's the numbers. Oop, oop, oop. A little bit bigger. Go down. So as you can see, all the numbers match. Revenue growth, 20, 50, 30. Profit margin. So I actually have share change here. They got rid of their share change function. I don't know why. Apparently there was some kind of issue with it. I set it to 0 in this comparison because they're also not factoring any kind of share change in. Profit margin is the same, 15, 18, 20. Free cash flow, 12, 13, 14. You can see it all here. It's all exactly the freaking same. 15, 15, 15%. Now, these bottom numbers are the earnings, multiple of earnings value and discounted cash flow value. Look at how much they match. It's almost like there's a mathematical underpinning to what we're doing here, as opposed to just buying a bunch of YOLO stocks. Because it's the future, bro. So yes, the numbers exactly freaking match. Of course, it's rounding. Like here I have 101.98 and they have 101.99. Oh, that's going to ruin your whole financial future. But everything else freaking matches, okay? Now, let's change some numbers. Let's do 50, 60, 70. And then we'll do 30, 40, 50. Okay. Oh, it's a boy. 50, 60, 70. 50, 60, 70. And then profit margin was what? 30, 40, 50. Hopefully this works. I checked this a couple times. It's always good to check your model against other people's models to see if there's an error. So let's take another screenshot and see if the numbers actually updated correctly. And I hope they do because I'm live streaming. Okay, so here we go. All right, 50, 60, 70, 50, 60, 70, 30, 40, 50, 30, 40, 50, 147. Man, look at that. Isn't that hot, ladies and gentlemen? It literally is just math. They are exactly right. Once you know how to do this stuff, you can become a pretty good investor as long as you put good assumptions into the stocks that you're buying and you're patient. Now, once again, I'm not uploading this, okay? I'm not selling it to you. But yes, I may start using this going into the future. Let me show you exactly how I did it, all right? So like I said, I built this delicious model, which I freaking proved to you actually works, but I would always verify with other sources. But it's a simple discounted cash flow analysis. And I like how I have share change here because then I can actually, look at it with more assumptions. So all I did was I copied this crap over. And on the bottom here, I have all these formulas that calculate the discounted cash flow for each different set of assumptions. So for example, let's look at multiple of earnings. So this is using net income, net profit, and we'll see how I did it. So on the first line here, and this is only for 5 years. So if you use this for any other time period, 6, 7 years, which is why their software is still superior by far to mine, because mine is only for a 5-year analysis period. I'm not good enough in Excel to freaking do all that crap. Maybe somebody smarter than me can do that. But this is a 5-year analysis. So I start off and I list the revenue for the next year going forward. Oh, that's ugly. Ooh, let me fix this. Excel can be a freaking pain sometimes. All right, that just totally screwed it up. Let me move this over. There we go. So, starting from the beginning, multiple of earnings. So I listed each year. So I have year 1, year 2, year 3, year 4, year 5. And then I have a terminal multiple. That's basically the market cap that you think your company is going to be trading at when you sell it in 5 years. Now, you have the years at the top. Blah, 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 blah. The first assumption is revenue. So I listed my projected revenue for each year. So I take the original revenue for the last 12 months, and then I multiply it by the revenue growth rate. As you can see, this is referencing the revenue in cell J3. So if we go up, and you don't even have to copy this stuff into here. This is J3. So the cell's referencing this revenue, which ignore the rest of this crap. I just was fiddling with it. But this is the last 12 months of revenue for DocuSign, $1,957 billion. And then it multiplies that number by the revenue growth assumption, which is B4 on the input page. Revenue growth, okay? And then it grows the revenue by that rate. So every year you see the revenue growing by 50%. So 50%, 50%, 50%, 50%. The next line calculates the net profit margin. So on their software and in my tool, they have profit margin as a percentage of sales. In this case, I have 30%, 40%, and 50%. All it freaking does is it takes the revenue and multiplies it by the profit margin. So this cell right here, this $880 million, is just 30% of the revenue. All right. And I did that for each year. This is 30% of year 2's revenue, 3, 4, 5. Now, I also have a terminal multiple, which is the price to earnings ratio that you're inputting into your software. So on the low assumption, I put a PE ratio of 10. That is your ending PE on the date that you sell the company, which tells you your company's value at the date of sale. So what happens is I take the last 12 months of earnings, so year 5's earnings, and I multiply it by the assumed price to earnings ratio, the terminal multiple at the end of the model's life, which I guess 10 is, reasonable for, I didn't really go super in depth with the numbers. So don't worry about the numbers and the valuation. It's more about understanding. So that's how I got that terminal multiple here, which factors into your cash flow. Your investment is the present value of all future cash flows. That's either the earnings you receive or the free cash flow you receive, and it's the price that you sell the company at, however many years in the future. So that's how I got that terminal multiple there. Then I discounted it, okay? Because it is the present value of all future cash flows. So the further out you are going to receive a cash flow, the less it's worth to you. And if you discount that cash flow, factoring in time and your discount rate, that discounts the cash flow to give you your rate of return that you want. If you don't understand it, I'm not going to freaking go into super detail about discounted cash flows. But you can't just use the net margin and add all that up and, that's the present value of all my future cash flows. No, because you're not discounting the cash flows. You have to discount the cash flows at your rate of return. So this discounted cash flow here, it takes the net margin and it divides it by 1 plus the discount rate to the first power. You go to the next year, it's 1. It's the net margin divided by 1 plus the discount rate to the second power because it's 2 years into the future. All right. So you're getting your discounted cash flows, and that includes your terminal multiple. So because of the time value of money, your $44 billion or whatever you're getting in 5 years is actually only worth $22 billion to you right now because of the time value of money. Wow. And that number changes whenever you change inputs. But it's literally just referencing the discount rate, which is the desired rate of return. So if I change this to 10, let's see what that does. Oh, did the numbers change? The numbers changed. We'll go back to 15. Oh my God, the numbers changed. The numbers change again, right? The last two steps. Now you have to calculate the shares you think are going to be outstanding for each year. Because if you own one share of this company, you take the total cash flows divided by the number of shares, and that's your earnings per share. Are you watching this meat spin, Kevin? You should pay attention. So what I did is I looked up this company's most recent earnings per or shares outstanding, common shares outstanding, and then I did my assumption of how much share dilution there's going to be for a year. So it references cell B5. And if you see any errors, please let me know because I just made this. So B5 is the share change. So every year, the shares are going to increase by 3%. It's 1 plus the share change. So every year you see the shares going up by 3%. So I take my discounted cash flow divided by projected shares outstanding per year, gives me discounted earnings per share. Okay. The last thing I do is I sum up all of my discounted cash flows, and that gives me the stock price that I should buy it at right now. That's literally it, ladies and gentlemen. Okay. Literally it. Now, you don't have to make this, and if you don't understand this crap, don't even freaking think about making this. Use their software. But it is possible to make your own discounted cash flow models. I know there's more complicated models out there, and mine's not the most amazing thing, and I'm sure there's better ways to do it, but it freaking works. Okay, I'm getting the exact same numbers, and I can do share dilution, and I know it's correct because if I do 0, 0, 0, it perfectly matches their software. So that's it, ladies and gentlemen. But no, I'm not uploading this. Okay. Let's see if there's any questions. Keep it up, Chris. Thanks, bro. Laugh, laugh, laugh. Oh, you had to use Twitter. Yeah, they wanted me to tweet to get access, and I'm a little, I sell myself down at the truck stop, so I might as well tweet about it. You do have to tweet every time you report to Excel. You only have to tweet once, or at least I've only tweeted once. It's never made me do it again. The reason they got rid of the share change is the same reason they are already giving companies credit for free cash flow and don't want to double count that. I don't understand that because, you literally just take the earnings, the projected earnings divided by the number of shares. That's the projected earnings per share of one share of stock. So I don't know. Maybe I'm missing something, but that's what I think. SBH. Wow, you inspect elements and copy and paste into Excel. Yeah, I don't know. Maybe I did that wrong, but it's pretty ugly. No one uses to analyze investment. It's the future, bro. That's true. That's true. Anyway, that's it. You can make your own model, but you definitely want to check it against theirs, and then you want to check it against other people's, and you want to really research your own numbers because if you screw it up, if something's wrong with your model, you're freaking screwed. Okay, that's why I check against theirs, and I change the numbers and I use different companies. Because I'm still nervous and I'm making a mistake, which is perfectly possible. I'm not a genius, okay? Love me Microsoft Excel, as you should, okay? Especially in your career. Bitcoin, other crypto crash, 50% 1 hour. I made a truck stop model. I buy unprofitable companies with 300%. Yeah, just buy it in Robinhood. That's the future, bro. Okay, this Meat Spin Kevin knows how to make this model way better than I am. This is grade school for Meat Spin Kevin, okay? The real smart people, they buy massively unprofitable growth stocks and they just YOLO into them and buy options and gamble and day trade in taxable accounts and pay massive taxes. That's the future, bro. Not actually using math and reasonable assumptions. That's boring. Anyway, that's it. I'm going to bed. Like, subscribe, tell your friends about me. Everything money. Don't freaking sue me, okay? I'm not going to share this to anybody. But I don't think there's anything wrong with showing people a basic discounted cash flow model. All right, a couple more questions and I'm going to bed. Crypto's got the shaft. Yeah, I need to make a video just making fun of crypto. Why not? Simply counting the share change actually assumes the buyback is free for the company. Any buyback takes away money from the company. It would, but it wouldn't affect profit margin. I don't think it would. I'd have to think about it. But maybe I'm missing something, but you could be right. It takes away cash because you have to use cash to buy back the shares, but share buybacks would not affect profit margin. just put 70p on everything. Then this is a buy. All right, I'm going to bed, guys. Good night.